Why is it important for an individual to understand why the central bank changes rates and what to expect? Let's take a look. So the central bank meets typically 8 times per year in Canada, so every month and a half, to discuss whether it wants to keep the same target interest rate, whether it wants to increase it or decrease it. In extraordinary circumstances, it can meet earlier than that, so a month and a half is really the longest time you have to wait between announcements. What can we expect in those announcements? Well, if we understand the main mandate of the central bank, we could understand what kind of decisions they're going to have to make. And the biggest one being price stability. So if we can see that in the markets, there's this inflationary pressure coming in, well, they're going to want to slow down the economy to avoid having this spike in prices, this increase in prices. So they're going to increase interest rates. If they see an economic downturn happen where there's less production, there's less purchasing and whatnot, they're typically going to lower interest rates so that prices don't fall more and more and more, and that we don't fall into a recession. So because of that, you could start understanding what's going on and then make better decisions. And one of those decisions is to determine whether you want to have a fixed or variable interest rate on a mortgage. So if we think back in recent times, during the pandemic, when it hit, a lot of things had to shut down. And because a lot of things had to shut down, the economy was contracting. And what the central banks did, and it was expected that they would do so, is they lowered interest rates. So if you saw that shutdown happening and you were about to renegotiate your mortgage and interest rates were still quite high, it made sense for you to say, I'll get variable interest rates because it's going to go down. And then at some point, we were getting out of this pandemic. Things were opening up again, and economies were prospering again. So because of that, even though things were coming back to normal, they weren't going to keep interest rates low indefinitely. So we could expect interest rates to start rising. And at the same time as this happened, there were some supply shocks that happened through various reasons, but one of them was the war that broke out in Ukraine that had issues on grain and other big things in the economy that had big ripple effects on other goods in the economy, which led to some level of inflationary pressures. When I saw that happen, I called a mortgage broker, a friend of mine, and I told them, you better start switching over your clients to fixed interest rates, because the interest rates right now are really low. They're going to be able to lock in at this very low interest rate of like 2-3% max on their mortgage. And they're going to be able to use that and keep that for the next 5 years. And that's going to be very beneficial for them. Because otherwise, the variable rate rose up. And it rose up because we had rates that were low, a lot of stimulus packages during the pandemic. There's a lot of inflationary pressure that came through with that as well. So as inflation surpassed that 1-3% target range and started going up into like 7% territory, well, you could easily know, if you understand how these things work, that interest rates were going to keep going up to try to bring that inflation rate back in check. And those times, the best choice was to lock in early to have a low fixed interest rate. And then as times pass, we notice in the economy that inflation rates were coming back down. And they were starting to come back down towards that 2%. It was reaching like 3%. And if you wanted to know what was going to happen to the bank rate at that time, you had to look at the inflation reports. And as inflation levels got low, you could expect in those situations that they can start pulling back from these breaks that they were setting by having really high interest rates and start lowering interest rates again as well. Because if you keep interest rates too high too long, well, it slows down the economy to a point where you're going to overshoot this inflation target and you're going to start creating like lower production and a recession problem. So they started lowering interest rates in this process to bring back to a normal level. So through these trends, you could understand why the central bank makes moves and why it should be important for you if you're negotiating fixed or variable interest rates. So the big things to keep an eye on is what's happening with inflation. That's the biggest thing. And then afterwards, you could also think about like, are we in a recession or are we overproducing? That also gives you a good idea. But the main one is really the inflation reports. And with that, you could understand how they make their decisions. And you could also understand why in times where there's really high inflation levels, you might think, well, everyone's kind of struggling in those periods because everything's becoming more expensive. They should lower interest rates, but that is counterintuitive to the central bank. They want to keep interest rates high to reduce that inflation rate problem back down to a normal 2% level. And if they try to help out people in that period of time, well, it just makes matters worse. So it's always about trying to fix the problem as quickly as possible. And the way they do so is high inflation rate, we're going to increase interest rates to bring down, cool off the economy, bring inflation rates low. If we're falling into recession or people are buying less, consumer sentiment of the economy is going down, we're going to prop it back up with low interest rates. So hopefully you could understand how the central bank acts, how it uses inflation metrics, and how things evolved over time, and how you should have been able to see what was going to happen to the bank rates, the target interest rate in the overnight market in recent history. And hopefully when you have similar examples in the future, you could foresee the trends that are expected to happen instead of just reacting to the changes that the central bank makes when it chooses to make it. Hope you can understand how all of this works better. Catch you in the next one. If you found this video interesting, please consider subscribing or joining my class where I guide you to apply and expand on the information found in these videos to real-life examples. Have a good day.